Personal consumption expenditures, Fed's preferred, came in at 2.8% year-on-year in November. So it seems like energy-related costs are the ones that push the PCE, second to shelter prices. Personal income went up a little, savings dropped a little. For consumer savings, possibly, some might say it's because of year and festive season spending. Markets now are expecting the Fed to stay put in the next meeting and at most 2 rate cuts this year. The tentative estimated GDP growth for third quarter is 4.4%. Jobless claims dropped to the lowest level in 2 years. That's good news. So everything together, the economy continues to expand and consumer spending is still going well, even though there's inflation. Some comments here: consumer continues to drive the U.S. economy, and there's still resilience. You should see the common theme now that a lot are saying there's resilience in the U.S. economy. On to Greenland. Trump recently said that he and NATO formed a framework for the future deal to Greenland. This framework is still very unclear, but Trump mentioned it involves mineral rights and some defense systems. So because of this, Trump will no longer impose those tariffs that he said onto the European countries. Very quickly, you'll see the stocks shot up. By now, you should see the pattern and stay put. In fact, these little pockets of noise from Trump actually presented quite a lot of buying opportunities. For some background, basically, the Danish and Greenland officials say they're not for sale to US. The European NATO members supported Greenland by adding more military presence there. Then Trump threatened these countries with the new tariffs, but now he said he won't do it. So on to China's downturn in investments. Right now, the drop in urban investments is amplifying credit risk, particularly real estate property developers, constructions, and banks, noted by Fitch Ratings. Currently, there's a loss in confidence in the ability to repay debt. A lot of supposedly healthy property developers that are big in China because of the property downturn are pushed into distress. For example, the delay of bond payments, which is almost reaching default already, and residential prices dropped to the lowest since 11 years ago. The second half, like you see at the chart on the right, urban investments dropped a lot, and growth outlook is deteriorating because of the subdued domestic demand, the deflationary pressures, and also property downturn. The 3.8% drop in fixed assets is the first annual decline in decades. Among fixed assets investments, property is in it. It declined 4th consecutive year, dropping at 17+%, like the chart on the right here. Now governments and the lenders will tightening the limits and assessments on who to lend. This will create some short-term pain. So firstly, property developers will feel the pain. Banks will also feel it because it's now more stringent for them to lend. So then the interest earnings will be affected. But in the long term, this will improve credit profiles, which eventually will bring up the ratings. Banks will prioritize higher quality borrowers. For the time being, you might see some short-term fluctuations, but ultimately, investors are still relatively confident in China's investment market, and everyone is waiting to see the announcement of stimulus in March. To wrap the entire section up, let's look at the first sentence first. Markets will likely stabilize once fiscal measures are clearly detailed. So firstly, the Prime Minister called a snap election, and that's 2 years ahead of the original schedule in 2028. The election will happen in 8 February. This is at a time where Japan is going through huge changes, like coming out of deflation and the bond yields no longer at zero. But the most important thing is, how is Japan going to fund the growth? The government said they want to roll out a lot of stimulus to support the people, but how? So typically is from government revenue, which usually comes from tax, and then next, they issue more debt to fund it. So these are the main problems. But before that, some background. The Prime Minister currently has a lot of strong public support with ratings above 70%. So you see the chart at the right. The blue line is approval. Ever since the new Prime Minister took over, you see the blue line shot up. Disapproval is the one in red, and it's at quite a good low point. Investors are concerned about all of these policy proposals. Japan government wants to cut food consumption tax from 8% down to 0 for 2 years. The good thing is, household will enjoy it because they pay lesser tax then. This supports household spending. But the biggest concern is the tax cut will reduce government revenue by about $32 billion per year. And this will occur 2 years, and consumption tax is a key funding source for Japan. People are worrying about this is because Japan's finances are already very stretched. According to IMF, Japan is the world's highest debt to GDP ratio, 230%. So yes, stimulus is a beautiful story, but how are they going to fund it? Firstly, they will lose government revenue because of the tax cut. Next, the debt is already very high. You see a lot of concerns showing up in long-term Japanese government bonds. The 30-year government bond, it reached a very high point of almost 4%. That means there's a lot of selling activities. And also, investors expect higher returns as a form of risk compensation. And in the near term, currency yen very likely remained weak. The base case is if Takaichi won. This is a summary. Fiscal policy, large-scale stimulus, temporary tax relief, and then improving of infrastructure and defense spending. These will boost GDP in the short term. Household consumptions will enjoy the tax relief and subsidy support in income. Consumer staple sectors will benefit because consumers will enjoy tax relief, so there might be a short-term boost in sales, and some might even say an improvement in net margins. Infrastructure, defense, aerospace, and technology will also benefit. Consumer confidence is still under 50, which is still showing a lack of confidence, but there are some signs of a slight pickups. Investors will closely watch the outcome of the 8th February election. They'll want to know clarity in tax cuts. In the meantime, market volatility will persist in the short run, and once the election and policy proposals uncertainties are cleared, the volatility in Japanese market will subside. But with these short-term noise, we should always fall back to fundamentals. Like, for example, linking to the tech sell down that happened in 2025's quarter 4. The talk about capital expenditure. Tech industry is not the only one that needs high capex. There are many more industries, especially those that require physical objects and hardware intensive. Look at the fundamentals, like the market trends, the consumer consumption needs. All of these support growth, and so bringing it back to Japan, economic fundamentals still remain solid. There's been a few waves of a boost in workers' wages. This will improve household consumption, and when consumer consumes more, it'll rotate into corporate profitability. And hence, the share prices, the earnings per share, all will look more attractive and spur buying transactions, which typically pushes the prices up.